asset allocation, also exploring investment options that are available today, and also aiming at creation of an income stream for retirement years. To conduct the program, we have with us a team from Ingenetus Consultants Private Limited. It is a financial advisory organization. So from Ingenetus, we have with us Ms. Shalini Gera, Senior Partner, and Mr. Abhishek Kumar, Managing Partner. Welcome, Abhishek and Shalini.
Thank you for the invite, Tripti. May I take over from here?
Yeah, please, Shalini, all yours.
All right. So thank you everyone from Engineers India Limited for joining us today. Thank you, Tripti, for being a wonderful organizer for this event. My association with Engineers India Limited goes 9 back when I was still working with ICICI Bank. I walked into one of your offices located at Bikaji Kama Place, New Delhi, in order to give a presentation on corporate payment solutions. Coming to date, we will be talking on Nivriti Vidya. This is a webinar which is aimed at retirement planning, a guide to financial freedom for people who are looking at generating a corpus for their retiring agents. So once again, I welcome all of you, and without much ado, let's get started. I started sharing my screen. May I request any one of you to confirm whether you can see my screen?
Yes, ma'am.
All right, thank you. So, welcome over to today's webinar titled Nivriti Vidya, a guide to financial freedom. I'm Shalini Gera, Senior Partner in Ingenetus, and we also have with us my colleague Abhishek Kumar, who is the Managing Partner in Ingenetus. My program outline is going to be as follows. I'll give a brief on our company's introduction. I'll share a guide to investment planning. We'll talk briefly about mutual funds. We'll understand how to utilize our current corpus in order to thrive during our retirement years. We'll talk about current financial trends that you very much use for your retirement planning. And we'll have a brief quiz in the end. I'll request all of you to keep this session as engaging as possible. I'll request all of you to listen to each and every word that I'm saying, because I will be asking questions in the middle as well as in the end of the session. I'll request all of you to use the chat box as much as possible so that we do not have any background noise. So please do utilize the chat box in order to answer or put forward any questions. A brief about us. Ingenetus Consultants started in the year 2012. We've been in the market working since the past 8 years now. We started initially as a mutual fund distributor operating in the investment advisory arena. As I spoke to our investors, they wanted us to become a one-stop shop for multiple financial products. So gradually we ensured multiple verticals, including insurance advisory, lending advisory. There is a small division which also takes care of the real estate and interior division. About our background, I have an experience of working with 9 years with ICICI Bank, post which I moved to Ingenetus Consultants. The managing partner, Abhishek Kumar, had a rich experience of a decade working with multiple MNC banks as well as domestic Indian banks. And post that, he decided to set up this organization. Talk briefly about our differentiating features, how we differentiate ourselves from the competition. We focus a lot on need-based products. So for this, I'm going to share a small experience from the beginning of my career. This was in 2011 while I was working with ICICI Bank, and I wanted to do my investment planning for the financial year. I wanted to buy a tax saver fixed deposit, which was giving me 9.5% return at that time. And I walked into a bank's branch, shared my requirement for a fixed deposit. I was met by a well-dressed privileged banker who asked me why I wanted to buy. He instead suggested me to opt for an investment product wherein I would have to pay X rupees for 7 years. And within 15 years, I would be getting double the amount. That was the pitch that he had used. face of it, it seemed wow. It seemed extremely exciting and tempting that I would be getting double the return, double the money that I paid in 15 years. And it was honestly very exciting till the time I realized the compounded annual growth rate or the return that that product was generating. When I calculated, that product was generating a measly 5% return. It was called a guaranteed plan. And since the plan was guaranteed an income to me post 15 years, it was compromising upon the returns. So I would like to give you a statement as to why do you think so many people, so many bankers and financial organizations opt for this product? Why do they suggest this product? Would anybody like to answer this question? Why do you think bankers suggest guaranteed investment plans to customers who look for investments?
No risk.
Security point of view.
That is correct, that they do not have any risk, that they are very, very secure. But other than as far as security is concerned, bank deposits are also very, very secure. If we talk about some of the debt mutual funds, they are also very secure. But why do bankers specifically focus upon guaranteed insurance plans to customers who are looking at investments? Why not a pure investment product? Would anybody
Looking at the security, bank of return, we prefer banks only. That's no government banks.
Definitely prefer banks. But my question is that why do bankers suggest insurance products offering guaranteed returns?
They are marketing people. They want to earn something, na?
Yes.
They are not doing for charity.
Absolutely.
They are not doing for charity. They are also in the business. They make a fool of people. The more they make, the better for them.
Yes, so you've given me the right answer, sir. Most bankers tend to prefer these products because they are very high in revenues for the organizations that they are working on. And in return, they end up compromising on the return that the investor gets. So while selling an investment product, while selling an insurance product, the bank or the financial organization tends to make a lot of money, often 50% of the entire premium that you pay. And then the end result is that you end up getting a return of 5 to 6%. So this was our concern. This was our pain. We worked with banks. We realized that banks were actually not doing needs-based selling. They were instead doing revenue-based selling. We wanted to set up an organization which was focusing upon the needs of the investor. And that is how Ingenetus Consultants was started. We work with a one single principle in mind, that is, and insurances are meant to be kept separate. If you want an investment product, you should opt for pure investment products like a debt mutual fund, an equity mutual fund, if your risk appetite permits you to do so, or stocks. And if you want an insurance, then you should go for a pure term insurance plan, which guarantees an income flow towards your life should an exigency or a crisis may occur. Moving on to the next differentiating feature that we have, we focus on technicals. So while recommending a mutual fund to investor, we do not just see the returns. I would also suggest you to do the same. Do not be concentrated, do not focus upon the historical returns. Historical returns are never an indication of the future returns that a mutual fund or any sort of an investment plan will generate for you. Always look at the technicals. So while during technical studies, we do a fundamental analysis of the mutual fund. We do a technical analysis of the mutual fund. We understand who the fund manager is. We make sure that the fund manager should have had at least 20-year experience working in the financial industry, who would have seen all sorts of business cycles, including the Harshad Mehta scam in 1992 to the current pandemic crisis. And he should have had the experience of taking out money from financial markets and ensuring that he is able to safeguard the returns for his investors. We also do a study on the various technical ratios involved for mutual funds as well as stocks in order to do an in-depth analysis to understand how one mutual fund or a stock fares better as compared to another. And our third differentiating feature is that we have complete transparency of revenue structure. So during the discussion, we are always able to point out the sort of revenue structure that we have for our organization, the sort of money that we will be making, and the sort of returns that we will be able to the investor. So these are the three key differentiating features that we work with. Moving on to the guide to investment planning, whenever I enter into a discussion with a prospective investor as to how he should plan his investments, my entire discussion revolves around 3 aspects, and so should yours. You must understand what are your goals for which you are planning your finances. You must be able to divide these goals into 3 parts. That is a short-term goal. A short-term goal will have a tenure of 1 year. A medium-term goal, the goal will have a tenure between 3 to 5 years, and a long-term goal which will have a tenure of over 5 years. You should also understand the risk profile before taking up any sort of investment. You should also be able to understand the risk profile.
Shalini, sorry to interrupt. Shalini, sorry to interrupt. I would request participants to please turn off their audios and videos. Yeah, please continue, Shalini.
Thanks. Shweta is my team member. Shweta, please mute anybody who is on unmute during the presentation as well. All right, so moving on to the risk profile. Always point to understand what sort of a risk profile are you carrying. We broadly categorize risk profiles into 3 parts. One is a conservative risk profile. Conservative risk profile means that you are extremely focused upon your capital protection. You are okay to take a lower risk return spectrum, provided your capital is being safeguarded. You're even okay to make a decent return. You are not bothered about extremely high returns, but you have to make sure that your capital remains protected. The second sort of profile which is there in the market is a moderate risk profile. Moderate risk profile means that you are okay to see some sort of a volatility in your investments, provided you know that your investments will generate your desired return in the next 3 to 5 years. The last investment profile that we have is an aggressive risk profile. Aggressive risk profile means the customer is willing to see even a capital erosion in the near short term, provided he knows that the investment that he has undertaken matches his risk profile and will give him the desired return in a 5-year spectrum. And the final parameter that you should know before undertaking an investment is understand what sort of a tenure you are planning. So each mutual fund, each stock, any investment that you pick up in the market will have an ideal investment tenure. You can plan your investments for either less than 1 year. There are different products suitable for that tenure. You can plan your investments between 1 to 3 years, different products for that tenure. And the next investment tenure is 3 years onwards. So before getting into a discussion with a financial planner, always be clear about these 3 parameters for yourself. Then choose a suitable product basis these 3 parameters. All right. So we talked about goal planning in detail. Most of the customers, most of the prospects that I speak to generally have these financial goals. We have children's education, we have a child's marriage, we have retirement planning, a house purchase, and vacation planning as well. So I'm sure for most of the segment that I'm speaking to over here, you would have taken care of your children's education, you would have taken care of your house purchases, your children would have already been married by now, or they would be on the verge of getting married. Your EMIs would have been taken care of. So for most of the segment here, we would be restricting our discussion to retirement planning and vacation planning as well during your retirement.
I suggest that there should be one for exigencies also.
All right, emergency planning. Sure, I'll talk about that as well.
Or anything like that, yes.
All right, I'll make it a point to talk about that as well. So thank you for bringing that point out to us. That is indeed a very, very important goal to have, which is emergency fund creation. It has very recently come to light during the pandemic as well, when a lot of people in the private sector unit have lost their jobs. So it's very well advisable for any investor to create an emergency fund. This emergency fund should have your savings to the extent of 3 to 6 months. So even in the worst case scenario that we do not have a job, or we have a health crisis at home, or somebody requires a hospitalization, we should be able to dip our hands in this emergency fund, which should ideally have a corpus of 6 months of your expenses. So think about 1 month's expenses that you incur, multiply that by 6 and plan that into an emergency fund. This emergency fund needs to be highly liquid in nature because naturally, if it is to be dipped into, you need to make sure that you are not pulling out from your capital and that your fund is also generating a suitable return to you. So I'll talk about the various investment instruments that you can utilize in order to put into your emergency fund. We'll gradually come to that in the next few slides. So my question from all of you would be that you are soon going to retire, you would be planning your retirement in the next 10 years. So what are you seeking a retirement from? You can unmute and you can give me the answers that you think are true. What are you retiring from? What are you planning your retirement from?
Salary.
Salary.
Charlie, the retirement planning is that we should be able to sustain the lifestyle we are having existing lifestyle. At least that much return should be there.
All right. So sustaining a lifestyle. Anything else? What are you planning a retirement from? हम किससे रिटायर हो रहे हैं अगले 10 सालों में?
From a steady source of income.
All right, source of income from your service. What else? और किस चीज से रिटायर हो रहे हैं हम?
Maybe from a regular lifestyle, whatever we
Yes.
are doing.
Yes. Yes. You're very, very close to the answer that I am looking at. Anybody else? What are we retiring from? हम retirement planning किस लिए?
Active work life.
Active work, okay. Active, yes, we're on the lines of the answers that we are talking about.
Madam, financial.
I'm sorry?
Financial.
You're retiring from financial.
Financial. Because earning is not there in that time.
Okay.
No, retire from an employer.
All right. You're retiring from your employer. That's correct. So,
Sir, webinar.
Okay, so we spoke to a lot of a large audience also planning their retirement prior to this, and most of the that came were similar to yours. I'll tell you what were the answers. They were planning retirement from stress. They were planning retirement from hassles. They were planning retirement from anxiety, from pressures, from work overload, and dependency from service income. So you've rightly pointed out most of the answers. And हम लोग इसी के लिए अपनी retirement plan करेंगे. What is
Madam, all these retirements may not be there. Only financial retirement, maybe continuous flow of money is not there. That is the only. All other worries will be there. Until you are there, you cannot retire from stress. You cannot retire from your active life. As long as you are active, you cannot retire. You cannot sit in the house. Even during pandemic, people are not able to sit in the house. So if you are active, you are only retiring because you are not having a steady income. That's all. Rest, everything will be there. Stress will be there. Pressures will be there. Workload will be there. None of these people will be sitting in the house. Although they are all technical people.
In fact, if you don't have another source of income, your stress level may increase. You may not be retiring from your stresses.
Absolutely. So we are actually looking to retire from these particular problems.
These are all technical people. They cannot sit idle at home. Even if they want, they cannot.
Point taken, sir. The assumption over here is that you are retiring from an active work life and you will be moving towards a life where you can actually plan your work. So after 60 years, there is no compulsion on you to work.
Right, there will be a compulsion if you don't have a steady income. You will be compelled. Because the lifestyle which you are living, if you don't have a steady income, you don't have another source of income, you will not be able to sit. You will be under pressure always.
Sir, उसी के लिए हम plan कर रहे हैं. So मेरी आगे वाली जो slides है.
We want that how to maximize our income from different sources after we
retire.
get some, you are not in the regular income group.
Right. So we'll come to that. My slides in the next part of the presentation are going to talk about how to generate a sustainable income during your retirement years as well. So my active goal is actually to achieve financial freedom when I do not have to rely upon the income which is coming from my service provider or my organization. So जब retirement planning की हम बात करते हैं, we tend to feel that we have a lot of time. If you speak to a person who is 25 or 30 years of age, उससे अगर retirement की plan करेंगे, बात करेंगे, तो वो बोलेगा I am not interested in talking about that because people feel that they have a lot of time. But the system is actually changed in the current time. From a joint family, we've moved to a nuclear family now. We are no longer living with our parents, our grandparents. Sometimes our children, once they get married, they also decide to leave to a different family. They move towards a nuclear family. So as a result of this, in the 1980s, the earning age has increased from 1980s to now. So I'm sure most of you or some of you at least would have started earning by the time you would have reached 18 to 20 years of time. But up time change ho gaya. They want to focus upon higher studies and they want to move their earning years to 25 after they've completed their higher education. Retirement age has always reduced. While you are still between the age group of 50 to 60, now most people actually want to retire by the time they hit 50. And what is the consequence of this? The consequence of this is that the earning age, the earning period is actually reduced. So initially it used to be between 80 years and 58 years. A person was working and a person was earning an income. Now the earning age has reduced from 25 to 50 years. So also due to the advancement of medical facilities, the life expectancy has also increased. So while in 2006 it was 68 years, the average human being was surviving till 68. In 2016, we are talking about a life expectancy of 85 years. So in the past, we had 40 years of a work life in order to support us for 10 years of retired life. But as a result of change in medical facilities, as well as our desire for a higher education, the current scenario is such that we only have 25 years of a work life to support us for 30 years of retired life. So this is a big problem. It's a big problem statement which needs to be addressed. Otherwise, the way you've said, we are still going to live under stress and pressure if we do not have a required income stream to support us during our retirement years. 75% of the population is seeing a funding gap. They're realizing that the corpus that they have generated now is not sufficient to take care of the retiring years. 63% actually believe that it is their responsibility and they're looking out for options in order to complete this gap. 58% of the population is actually regretting the fact that they did not start early enough. They did not plan for the retirement early enough. So retirement planning is not just a need for people who are at the age of 50. It's a universal need for every segment. It's a need for young, middle-aged, old people, businessmen, executives, holiday makers. Everybody and anybody should be thinking and planning for their retirement. In fact, it is said that as and when you start working, you should start investing just 5% of your monthly income towards a retirement planning goal, which you will not touch till the time you attain the age of retirement. So, हमारी life में 3 stages आती है. The first stage is accumulation, during which we earn income and we build a corpus. The second stage is nesting. Nesting stage talks about delivering a return on your accumulated corpus. And the third stage that we talk about is distribution. Distribution talks about taking a cash outflow from the corpus that you have created. So देखिए हमारे सामने 2 graphs है. The first graph talks about the accumulation stage. So you can see that the person has started his life, his earning age at the age of 25, and he is constantly earning and building a corpus till the age of 40. So this is his cash inflow that is going towards his investments. This is also called the building freedom and stability journey. So in the first graph, you can see that the person is building a corpus by putting in an income stream towards his retirement planning. And the second graph, the blue line, is your corpus that is generated, and the cash inflows which are coming from the corpus, And the second orange line is the lifestyle that you have. So you can see that the lifestyle is comfortably actually growing from the age of 40 to 80. It is not constant and it is not degrowing. So the person is able to actively utilize his corpus and is able to generate inflation adjusted cash flows from his corpus. Blue line is the corpus which is still there. It means that his corpus that he created at the age of 40 is gradually supporting him till the end of 80. So he has a steady cash flow available for his corpus to thrive during his retirement years. So, इसके बारे में आपको थोड़ा सा मैं डिटेल में बताना चाहूंगी. I'm going to show you a cash flow calculator that we had prepared exclusively for you. So we'll talk first about the accumulation stage. I'm going to quantify figures for you so that you know what sort of a corpus are you have by the age of 60 so that you can live a comfortable lifestyle during your retirement year. Let me start with a modest figure of 60,000. So most of the people here are in between the age group of 50 to 60. We are assuming that you would have taken care of most of your responsibilities, like your children's education, like your EMIs for your car as well as houses. These would over by now, and we would be left with some of the other liabilities, and we can easily plan an SIP or a monthly investment towards our retirement planning for 60,000 rupees. I hope everybody agrees with this figure over here, and or whatever changes in this figure.
Madam, return of 10% doesn't seems to be on higher side.
Sir, पहले आप मेरे को SIP के बारे में बताइए. Are we comfortable with the amount of SIP which is 60,000? Is this a decent?
Madam, if people are comfortable with the amount, they are more interested in that percentage.
Percentage.
Amount can be
60,000.
60,000 per month.
They are more interested in that percentage. How much return will be available?
Percentage
Not
return.
theoretical, practical.
No, Shalini, the 60,000 you are saying per month.
That's right, sir.
Nowadays, people are talking about
that is on the higher side because many people they have their housing loan and all those things. So SIP of 60,000 will be
60,000 per month is the higher side, yeah. But
Is on the higher side. Should we make it 40,000? Does that look okay?
I think better you keep it at around 30 or so if you are starting at the age of 50.
All right, so 30,000 karte, you'll soon realize that it is not a sufficient figure that we should be planning. Rate of returns or 10% हम इसीलिए लेके चल रहे हैं because we still have 10 years to plan for our retirement. We are not at an age when we are not earning, so we can take a risk over here. So this 10% of a return.
Look at the returns from the equity large cap funds. For last 5 years, the CAGR is just 7.98. And if I look at the last 10 years, it is 7.53. I'm looking at the total returns from the equity large cap funds. So I don't know from where you will generate 10%. I'm talking about the actual data last 10 years. I'm not talking about hypothetical figures.
All right. Sir, जब हम debt
I
mutual
think you make it 8%, then it will be a more realistic.
Sir, 8% is a return that we can expect on a conservative level from just debt funds when we are not even taking a high degree of risk. If we have
that's okay, but at the moment because of that volatility and all that things, most of that your mutual funds they are not giving more than 8% or so. Very
Yes,
few
that is actually
11 or 12 or 15. There are few of them. Those who have done good, but most of them, in fact, those who have invested in last 3 years, they are in negative side only.
Yes, sir. No, yes, sir. That is actually not true. It's an incorrect assumption. Why? So most of the debt mutual funds are able to generate a conservative return of 8%. A pure debt investment is something that I will plan for an investor who is already retired, who's at the age of 60. If I park your investments into a combination of debt funds as well as equity funds, we can definitely generate a 10% return. Having done that in the past, I am telling you with experience that we've actually done that. Then, sir, as far as your question about pure large cap funds are concerned, you might be right about some of the funds, but you need to be constantly doing portfolio adjustments. You cannot stick with a single mutual fund and monitor its history over 10 years and say that they've delivered only 7%. No, You have to constantly do asset allocation as per the market scenarios. You constantly have to shift between debt and equity, and that is how your portfolio is actually able to deliver results. Talking with experience, we have been able to generate 10% returns in a mixture of equity and
But,
10% debt and 20% equity.
are you suggesting that we keep on switching funds in between?
It is required, sir. It is not required to do so the moment you get panicking, no. But portfolios need to be constantly looked at. They constantly need to be exited and entered into. I would say at least on a year or 2 year basis. That is required. You cannot stick with this.
Agreed. But you invest in an SIP or in a mutual fund only to have a steady income.
Correct, sir. So we are not exiting that
if I have to do all that manipulation for switching from one fund to another, then in fact, if you are investing in 4 or 5 good funds, and you should sit tight on that, not keep on switching every year from this fund to that.
Not every year. No, not every year. It's not required every year. But funds tend to have cycles. Funds will always be winners and losers. So one fund
you will be
right now will not
2% of exit
perform well 2 or 3 years down the line. Those changes have to be made.
Sir, Shalini, we'll just address this point in the end, sir. I've taken this point. This is Abhishek. And I will come to the changing part of the fund and why we should actually do that right at the end of the presentation. I'll take that question myself. And we also talked about 10% return.
Shift the question to the end.
Yeah, we'll shift the question to the end. Thank you for it. Abhishek will definitely take this question towards the end.
Actually, if it is resolved right now, we are more interested in the question answers, not in the presentation.
Sir, there are still parts of this presentation that you must look at. At least this particular table is very important. You must be able to see what sort of a return or a corpus is a 30,000 income with an 8% return generating for you. I can make this 8%, not.
Madam, what I am telling is people know how to calculate this interest. They are only interested in how to maximize their returns in terms of percentage. They are not interested in 30,000. They may be investing 30 lakhs. They may be having a corpus, but how to maximize the returns through your services or through some expertise, experts, that is the issue. Because otherwise, calculating that after 10%, how much will be the return, everybody knows. People know how after 30 years or 20 years, 30,000 will become. But what will be the rate? What is the minimum guaranteed
income stream that we can generate? We'll talk about the income stream that we can generate, and we'll also talk about maximizing that income stream over here. So
yes, that is more important.
All right. So from a financial advisory perspective, sir, we will be recommending an asset allocation which is able to generate a 10% return for you.
Yes.
So starting with the age of 50 years, if you start investing 30,000 rupees at the age of 50, you start with a corpus of 3.7 at the age of 50. And by the time you retire at 60, you have a corpus of 70 lakhs. Okay, so we'll this figure of 70 lakhs, 27,000. You can see over here, there's a corpus generated of 70 lakhs at the age of 60. If you do an SIP of 30,000. So, इस 70 lakhs की figure को हम यहाँ पे ले आते हैं. So, we are working on a constant withdrawal of 8 lakh rupees per year, and this figure is also inflation adjusted. So we are keeping an average figure of 4% in mind that our purchasing power is going to reduce by 4%, and this 8 lakhs will continue to be inflation adjusted every single year. So this 70 lakhs of a corpus is only going to last you till the age of 69, which is not sufficient. You can see that your lifestyle is increasing over here, and your corpus is immediately ending at 69, which is precisely why we should look at two aspects. Either we need to increase this income flow, number one, or we need to look at reducing this lifestyle. So the better part, the more preferable aspect would be if we can, because we do not want to live with a low lifestyle, we want lifestyle that we were used to. We want to in fact maximize that lifestyle. I'm sure you would have a lot of other desires in life, including going for a vacation or perhaps starting your own consultancy where you can put in some income to build upon your own business, which is why it's absolutely important in order to maximize this particular inflow when this is possible, and this is possible only right now. It cannot be possible when you reach 60. So you can see that अगर हम इसको 60,000 per month कर सकते हैं, we can easily take our corpus to 1.4 crores by the time I retire. And then you can see that my corpus is going to last till the age of 84, which is a decent age to consider. I hope everybody is clear with this particular calculation. If somebody has a concern, please do put it up at the end.
Okay, how much you have increased that SIP to?
60,000. So this is the initial figure that we had kept.
Mm-hmm.
So coming back,
in fact, what you have done is straight calculation, but in fact, what you are supposed to do is that say in 50 up to 50 to 54, if it is 30,000, after 54 you take it to maybe around 50,000 or 60,000, and maybe after that you increase it to maybe 70,000. Then it makes a better sense that because that people they will have more disposable income at a later part of their career than in that initial. Because up to 55, many people have their housing loans which get closed only by that time.
Okay, all right. Sure. Then we can
which we are missing here is all of us have a pretty decent amount of PF which we are going to get at the time of retirement.
Correct.
You are not taking that portion into the consideration while showing us for how long the corpus is going to last. And
sir, इसके अंदर PF का contribution.
PF, we also have the superannuation pension scheme at the moment, which is we'll be getting some lump sum.
I'm aware of that, and you'll be getting the pension stream out of that as well.
No. The thing is that out of with these whatever we are getting at the time of retirement, that should be how to invest that amount, because that will be that major portion most of the people will be getting when they retire, which is now at the presently with the PF or maybe PPF or something like that, and what they get at that point of time, that should be planned how to invest that because that will be somewhere around maybe around 15 to 20 million.
All right. Okay, so because that's something that you're going to get only at the age of 60. We'll talk about those investment avenues as well.
During
so we'll talk about those investment avenues.
Yeah.
So coming on to mutual funds, a lot of investors, old age investors that we do speak to, talk about investing their retirement corpus into fixed deposits. So I would like to give you a brief upon fixed deposits as well as mutual funds. There is a comparative analysis. This is entirely basis various parameters. In the second slide, I'll be talking about the returns. So fixed deposits are definitely giving us a fixed return, but unfortunately the returns have come down to a 4.9%, 5.4% if you are a senior citizen, and they are on a constantly downgrading mode. So RBI has already adopted an accommodative stance. It is already predicted that there's going to be a further 50 basis points of a rate cut in the current financial year, which means that these rates are already going to go further down. To stay over here. Globally, we have countries which are at the deposit rates of 0 to 0.25%. US is at a 0.25%. UK is 0%. Australia, Canada are at 0.1%. Japan is one exception, which is actually in negative, which means that you have to pay towards a bank in order to deposit your money. So we are gradually moving into that direction. And if the demand in our economy is supposed to grow, our government does not have any option other than to cut down the rates. So fixed deposit rates are going to go down, while debt mutual funds do not offer any guaranteed return. They do offer a return which have been historic deposits.
Another think that in case if we are talking about fixed deposit returns going close to zero, you will still be able to maintain 7% returns from debt funds?
All right, sir. Again, I'll take this question towards the end.
Okay.
I'll make a note of this question.
So tell us which category of debt mutual funds you are talking about, because there are at least 4 or 5 categories even in the debt funds.
You're absolutely right about that. So let me just cover this slide on fixed deposits and debt mutual funds, and we'll come to types of mutual funds as well. The debt mutual funds have a categorical advantage adjusted return. So while fixed deposits are not even covering an inflation figure of 6%, debt mutual funds will be able to take care of your inflation aspects. We are talking about an 8% conservative returns on debt mutual funds, and inflation figure, even if it has 6%, we are able to get an incremental return on 2% on debt mutual funds. Fixed deposits have a low risk, debt mutual funds will have a medium to high risk associated with them. Liquidity, debt mutual funds are highly liquid in nature. Most people are not aware of that. People think that debt mutual funds or any mutual funds will have a lock-in period. There are only specific category of mutual funds which come with the lock-in, like ELSS or fixed maturity plans. The rest of the mutual funds do not have any lock-in associated. They are highly liquid to the extent that you can put in a redemption amount today and you can get 90% of your funds redeemed into your bank account immediately. Otherwise, on most debt mutual funds, the liquidity period is T+1. That is, you put in a redemption today and you get the redemption tomorrow in your bank account. And in equity, it is 3 days. Moving on to premature withdrawal, you can do a premature withdrawal in debt mutual funds, but there will be an exit load, just like it is applicable in a fixed deposit as well. There is a cost of investment associated with debt mutual funds, which is called as the total expense ratio. This is generally to the extent of 1.5%. Which will be the cost if you come out of your debt mutual fund, if you redeem your mutual funds. Fixed deposits have no such cost. Please note that debt mutual funds are highly tax efficient in nature. So the government has given us a figure of indexation. So while most of you are likely to be taxed on your fixed deposit at the rate of 30%, which will be your tax bracket, after 3 years, debt mutual funds will carry a figure of indexation. So the net taxation available on your debt mutual funds will be 20% post-indexation. So I'll come to this comparative analysis in the next part. So I've taken an example of 1 lakh rupees, which is invested in a fixed deposit and in debt mutual funds at the same time. You can see that a 4.9% annualized return on a fixed deposit is actually yielding a 3.5% post-taxation return. While in case of debt mutual funds, if we are investing for more than 3 years, there is an indexation figure which comes in, which means my total post-taxation return reduces to only 7.9%. So you can see that there is a difference of more than 3.5% in a fixed deposit and in a debt mutual fund in the current scenario. So it makes more sense to stick to a debt mutual fund rather than the fixed deposit, where you're taking almost the same amount of risk. So these debt mutual funds, I would also like to inform you, where are they investing? These debt mutual funds are investing into government securities, they're investing into PSU bonds, into private sector bonds, into Government of India bonds. These are the various categories of securities that a debt mutual fund invests in. They do not invest in the stock market. So if anybody has a confusion or a misconception over here, debt mutual funds do not invest in any equity, they do not invest in stock market. So most of you are aware about mutual funds, but for the people who are not aware, I'd just like to do a brief introduction on how mutual funds actually work. Investors like you and me, we pool in our money, we give these funds to a fund manager. A fund manager is a professional whose job in and out, day in and day out, is only to analyze balance sheets of companies, to analyze various portfolios, various securities, the sort of return rated in government papers or PSU bonds or Government of India securities. And basis the analysis, basis the choice of risk profile that you are taking, he decides to invest this corpus into those stocks and securities. They can either be equity, they can be government papers, they can even be commodities, or they can be a mixture of all of these. From these securities, the returns are generated and they are passed back to the investor. So if anybody has a confusion over here, I would like to allay that confusion altogether. Mutual funds do not necessarily mean stock market. That is entirely a misconception. If you want to stay away from the stock market and still make returns, there is an option to do so as well in mutual funds. Are they right for retirement planning? So you asked me a question, what to do with the retirement corpus that is coming to us at the end. So let's have a look at one of the videos that is available by mutual funds, Sahi Hai, and let's ask our ex-Indian captain, Dhoni himself, what does he think about retirement planning and investments? So is this screen visible to you?
Yes.
Yes, it is.
अरे माही अब रिटायर हो गया तब जाके टाइम मिला हमारे साथ खेलने का। मेरे रिटायरमेंट की बहुत फिक्र है तुम लोगों को। हर किसी को अपने रिटायरमेंट की फिक्र होती है, मुझे शायद नहीं होगी। मैंने फिक्र नहीं, तैयारी की है म्यूचुअल फंड्स के साथ। क्रिकेटर्स को पैसे दे दो तो वो कुछ भी कह देते हैं। पैसे दिए इसलिए नहीं, मैंने अपने पैसे वर्षों से म्यूचुअल फंड्स पे इन्वेस्ट किए, इसलिए कह रहा हूँ रिटायरमेंट प्लानिंग के लिए म्यूचुअल फंड सही है।
म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।
So this was one of the videos, and there's another video that I would like you to see, where there are two investors who are talking about mutual funds. They have, one of them is actually not aware about mutual funds.
वो सारी चीज ऐसा एग्री कर लिया।
हाँ वही तो।
डेस्परेट इन जॉब नहीं है, ऐसे सेक्टर में कहता है कोई जॉब बुकिंग नहीं है, डेस्परेट।
जी सत श्री अकाल जी। और भाटिया आज तू खेलने नहीं आया यार?
यार अपने बेटे के लिए इन्वेस्टमेंट कर रहा हूँ, अब उसे तो कुछ पता नहीं, ना ही कोई परवाह। कहने लगा पापा आप खुद ही कर दीजिए जहां मर्जी। अब वैसे मैं इन्वेस्ट करूँ तो कहाँ करूँ?
यार तूने ये नई टेक्नोलॉजी तो अपना ली, अब इन्वेस्टमेंट के कुछ नए तरीके भी अपना ले। मतलब ये बाकी के इन्वेस्टमेंट के साथ साथ म्यूचुअल फंड में भी कुछ इन्वेस्ट कर।
ओह, इसकी एड मैंने देखी है।
तो अब ऐड कर ले अपने इन्वेस्टमेंट प्लान में, लॉन्ग टर्म में ये सही है। मैंने अपनी बेटी के लिए भी यही किया है।
भाई बात तो सही है,
आज के जमाने और कल की महंगाई के लिए म्यूचुअल फंड्स बिल्कुल सही है।
म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।
All right, so these were two videos I wanted to share in order to apprise you of the fact that mutual funds are an available option to us for putting in a retirement corpus as well, because of the facts that mutual funds give us good amount of liquidity. They are highly liquid to the extent that we can even take the redemption amount within 3 days in equity and within 1 day in case of debt mutual funds. They are managed by a professional whose only day in and day out job is to analyze them and then to put in your required corpus. Mutual funds offer a very good degree of diversification. So all of you must have heard Warren Buffett's principle that you should never keep your eggs in one basket, but always diversify them. So mutual funds can take up 60 to 70 stocks in one single portfolio in order to diversify and in order to mitigate the risk. Mutual funds are highly tax efficient in nature. One, I've already given you the reason that they offer you a figure of tax efficient, and they are also able to save you as much as 45,000 rupees in terms of taxable income for your investments. So each year, just like investments in NPS, PPF, you can also invest 1.5 lakh rupees into mutual funds and get a tax exemption on 1.5 lakh rupees from your taxable income. This year, this way you are able to save at least 45,000 rupees in terms of your tax deductions. It is a very well regulated. SEBI is a regulator which is present for mutual funds. It has control over all of the entities, whether these are mutual fund companies, distributors, research advisors, or any entity who's operating in the industry of mutual funds will be controlled by SEBI. Any investor who has a grievance against any of the entities can approach SEBI for grievance addressal. They give you convenient options of entry as well as exit. It is not necessary that you should be parking in a lump sum. If you do not want to park your entire lump sum into equity, into mutual funds, you can also undertake investments into mutual funds through a systematic investment plan, which is a monthly input route. So I would like to stop my part of the discussion over here, and I would want Abhishek to take over the systematic withdrawal plan. So a lot of you had questions about how to utilize your retirement corpus that you get at the end of retirement in order to make most of the use of your retirement years. So Abhishek, I'd just like you to take over from here.
Yeah, thanks, Shalini. So do you want to continue with the presentation, or should we take Q&As from everybody? What do you suggest?
Q&A time is available from 12 o'clock onwards. You can take the part of systematic withdrawals, which everybody would be interested in. And we also wanted to talk about certain categories of debt mutual funds, which one person had also asked. So you can address both of these two questions this simultaneously.
Okay. So what I'll do is I'll just look at some of the options. I think we had one question about a 10% return over a 10-year period, which was coming out to be too high for some of the participants. So I'll just share my screen, and we'll just look at all the categories of mutual funds that we have discussed. You can see my screen, right?
Yes.
Perfect. So we talked about some large cap funds. So we're looking at a fund called Canara Robeco Blue Chip Equity Fund. This is a pure large cap fund, and we're not promoting anything right now, but we're just looking at random funds right now. So if we look at the returns on the screen, the annualized return for a 10-year for this particular fund is 10.35. And even for since inception, this fund was incepted 15 years back. So even that return is close to 10.89. Now, this was lump sum returns. Now, if we talk about SIPs, like we did in the example that we shared, which was 60,000 per month, the annualized return comes out to be approximately 11.77 for a 10-year period. This is a pure large cap fund we are talking about, equity mutual fund. Coming to a mid cap fund, so we just kind of see all the category of funds so that there is no confusion or any misconceptions there. This is a mid cap fund. I'll not name the fund. Let me just not name any funds right now. But if you look at the funds, a 10-year return over here is about 12.74. And if we talk about the SIP returns, the SIP returns is 10-year is about 14.43. That's the mid-cap returns we're talking about. This is a small cap fund that we have taken. So large caps, I'm assuming that everybody over here knows the definitions of large, mid and small caps. The top 100 companies of India are large caps, 100 to 150th company are mid caps, and 151st to the end are all categorized as small caps. So if we talk about a small cap fund, a 10-year return is about 16.32%. And since inception, the inception for this fund is more than 10 years, is about 17.28. And if we talk about SIP returns, a 10-year SIP return is about 19.32 for this particular fund. This is a small cap category. Now, in most of the discussions that we had in the presentations, we talked about debt mutual funds. I'm taking a particular debt mutual fund and I'm just showing you the portfolio first of all, so that there's no confusion. So this portfolio has GOI. GOI is Government of India securities. About 58% of this portfolio is into Government of India securities. 36% are non-convertible debentures and bonds, and about 1.15% are pass-through certificates. If we talk about the So SEBI has, advised us to, advise every mutual fund to put every category into a risk category as well. So government backed, of course, there's no risk, so it cannot be categorized. So it's government backed is about 58%, and low risk is about 37.31% in this particular fund. So there are no stocks in this fund, just Government of India securities and non-convertible debentures and bonds. If we talk about the returns, the annualized return for this particular fund for a 10-year period is 10.19%. Since inception, it's 9.84 because this fund was incepted more than 10 years. So more than 10-year return is about 9.84. And if you talk about the SIP returns that we talked about, it is 10.25 for 10 years, again, per annum. So annualized, when you talk about annualized return, they are per annum returns. And if you see any other period also, they are very close to 10 or above 10. So for in a 1 year period, for example, you've got 12% also in the last 1 year. And in the last 3 years, we've got 10.76. And this is a 100% debt fund. So when we, talk about returns not being there, that's a misconception because in a 10-year period, we get that returns. Now, I understand a lot of participants also said that, in the last 3 years, the funds have not performed for some of the participants or the return was not there for the past 3 years. So here is where the value of shifting your mutual funds and taking a call according to the market comes into picture. Now, if I talk about a 3-year return also, let's say in a large cap fund, I think some participants pointed out that in 3 years, it's not 10%, it's more than 7-8%. It's about 7-8%. So that's correct. So in a 3-year period, a large cap fund has delivered 8.85%. But if we talk about SIPs again, in a 3-year period, they have got 11.42% in a 3-year period in a large cap fund. So why do we need to change? Why do we need to change? I'll just stop my screen right now and just address the questions which we got. Now, we would recall a lot of phases in the market. I didn't want to
just like to intervene.
Yeah.
Actually, all this assumption is based on the fact that your Sensex or the equity keeps on rising. Okay, like what we found in the crash in 2007. That time my mutual fund was maturing, so my value went down to minus. So how do you anticipate such sort of a shock?
You don't anticipate this, Mr. Iyer.
Giving you 7% or 10%.
Mr. Iyer, to be very honest, and being very candid with you, nobody in the world can predict equity markets. Now, what happened in March, due to COVID, markets crashed again. It was a replication, somewhat a replication of 2007. Nobody anticipated a Sensex to fall from 40,000 to 26,000 kind of levels. So how you manage that situation is by asset allocation. What do I mean by asset allocation? Let me give you an example. Let's say I have 100 rupee to invest today. I say that markets look a bit overpriced right now. Let me get systematically into the markets and let me keep portion of it into non-equity linked investments. So I plan my investments in such a way that 50% is into equity and 50% is into debt. Now, depending on...
Excuse me, my question was, okay, if you are having a long horizon, like if you are young and you are investing regularly, okay, you can come out of that cycle maybe in a 10-year or a 15-year and then again make up your losses. But what we are talking now is after retirement, okay? So when I am parking my funds in some mutual fund and then tomorrow I require that and then the market crashes, then what happens to my fund?
So after retirement, if you're retired and it's a retirement corpus, we don't advise equity investments ourselves. This example was just given to you because some of the participants pointed out that in the large cap category also they did not get the returns and 10% was too high. So this example was just given to show the returns. But depending on your life stage you are in, how close to retirement you are in, we'll plan your equity. And if you're already retired and you want to generate income from it, Depending on your risk appetite and depending on the discussion we have with you, we'll decide how much equity or no equity. So in most of the
actually,
cases,
basically, because of time shortage, all our people are basically interested in that, like the retirement corpus, because maybe we are 1 or 2 years from retirement. All the basically the participants are in that
I'm coming
range.
to that.
So
I'm
if
coming
you concentrate on the retirement corpus, how we will be maximizing our returns and taking care of our this thing, that will be better idea.
Yeah, so I'm thank you for the feedback, Mr. Iyer. I'm coming to that, and I'm discussing that as well. But see, you got to understand, Mr. Iyer, that planning a retirement corpus can be different for you and can be different to somebody else, and it's very subjective. Right. So some people can be willing to take certain amount of risk and participate into equity. Some people might not, and some people would say, let's stay away from equity. So it completely depends on the individual and their risk profile. But if I talk about a generalized category, investing into funds which are non-equity based is more advisable after retirement, and generating a return out of them on a monthly basis, which suffices your monthly expenses as well. So, for example, I just showed you a debt fund which was giving a 10% return for the last 10 years. Now, and even if you compare the other period of returns, 3 years, 5 years, it was close to 10 or more than 10. If you take a 10% assumption, you invest your retirement corpus into a non-equity linked where there is no volatilities involved in your corpus, and from there what you can do is you can put a SWP, a systematic withdrawal plan of every month. So let's assume you have 1 crore of rupees today to invest. We put it into a fund which generates, let's say I'm not taking 10%, let me take a 8% or a very conservative side. I've shown you a debt fund which is given 10%, but let me take a conservative figure of 8% also. So 8% means I am generating about 8 lakh rupees per annum on a 1 crore basis, on a simple interest basis, of course, but first year I get 8 lakh rupees. Now, every month I'll be able to withdraw depending on the expenses that that person has. So, for example, some people might have an expense of 50,000, some might have an expense of 20, some might have an expense of 1 lakh, and the corpus will also vary. So, it's very subjective, but I can take out SWPs, I can take out monthly withdrawals from this corpus and plan my pension with that. Now, we have two category, we have a sort of a replicate for that, which is promoted a lot in the market, which are pension funds, which are linked to insurances, where you get annuity, you get either a delayed annuity or you get an immediate annuity. But if you put it on an Excel and calculate your cash flows, that I've invested this much today and per annum I'll get this much back, let's say starting next year or the same year or after 5 years. If you calculate the returns in those pension plans, it will not be more than 5% or 6% IRR per annum return. So on papers, as Shalini, when she started off with her presentation, on papers, these pension plans looks very good, but our advice is that it's better to accumulate that, put it in a non-equity linked debt fund, and enjoy SWP or a systematic withdrawal from it every month. Depending on your risk appetite, some people, even who have retired, who are 65 plus, say that, let's put 80% or 90% of my corpus into non-equity, and let's take 10% of that equity risk. I'm willing to do that because I want to increase my returns, and I'm willing to, take that 10% or 20% of equity risk because I have time with me. My 80% of my corpus will suffice my monthly expenses. My SWPs, my withdrawals will come every month, so I'm happy with it. So I really don't, require that 20% on an immediate basis, and I have time for that, and I can take equity risk for that. So we plan equity in a systematic way for those people who want to take risk. But after retirement, we try to make it a point that equity exposure doesn't go beyond 30%. In some cases, we do have above 30 also, but we make it a point that it does not go beyond 30% because your source of income after retirement is only that corpus, and we don't really want to take too much of risk on that corpus. Our preference would be 100% non-equity or debt-based investments with some exposure. If somebody wants some exposure for 10-20% of equity exposure, but not more than 30% of equity exposure. So with your retirement corpuses, what we'll recommend is, depending on your risk appetite, depending on how much risk, how much expenses you want after retirement, what is the corpus we're talking about, we can make a plan of how to go about it.
One question here, you talked about the debt funds, but you didn't tell us anything about interest rate risk or the credit risk. Can you just tell us on that so that people are aware what are the risks associated even with the debt funds?
Yeah, Mr. Miglani, we can discuss that. So in debt mutual funds, there is something called a credit risk or a interest rate risk. What does that mean? For example, let's assume that the repo rates, I'm talking about the interest rate risk first. So let's assume two scenarios. In one scenario, the repo rate in the market is going down, or the yields in the market are going down. Now, in such a case, whenever interest rates or yields go down in the market, the prices of the bonds increases. They are inversely proportional. So whenever it's an interest rate cut kind of a scenario, we get more than expected returns from debt funds. So for example, last 1 year. So if you saw the returns which I showed in the screenshot also when I shared my screen, last 1 year return is 12% in that particular fund. Now this is because in last 1 year we've got a lot of rate cuts in the repo rate, and we've got a lot of rate cuts, interest rate cuts in the economy as such to support the economy. So whenever a rate cut happens, our debt funds tend to perform more than expected, which is about 12%. And whenever a rate hike happens, rates go up, we generally get an average kind of a return or less than average kind of a return, but those returns are still anywhere better than as compared to a fixed deposit. Now, what this, as Mr. Miglani pointed out, what does this do? So, for example, if what I showed you, the returns in the screen share that I had. Now, if somebody would have invested last 1 year let's say he invested on November 2019, he did not expect a return of 12%. His expectation was 7-8%, but because the interest rates in the market went down, he got more than what he was expecting. This is what is called an interest rate risk. A second risk, which is there, is a default risk. What does that mean? Let me take an example of any corporate bond that I take today, right? Let's assume a bond is there which is giving me a return of 9% per annum for the next 10 years, and I invest in that particular bond. The risk which is there is, what if the company closes tomorrow, right? Or doesn't have a potential to pay back your money after 3 years. They've made a commitment for 10 years, but what if they don't have that money after 3 years that they can pay it back? Now, in most of the debt mutual funds, the debt securities that they raise, apart from the government bonds that they raise, but most of the good mutual funds we're talking about, they generally, when they raise a paper, they raise it with some kind of a collateral or the other. So for example, if I'm buying that, if I'm a mutual fund and if I'm buying a bond from a particular issuer, what I'll do is, let's say if I'm taking 100 rupees of bonds from him, I'll first of all make my due diligence done that, everything, the rating is good, the company is good, there's no problem there. I'll do that due diligence. But I will also ask some sort of a collateral from them. Now, those collaterals can be different for different mutual fund companies. Some mutual fund company might take a 2x collateral, some might take a 1.5, some might take a 3x. that depends on company to company, but most of the companies try when they take a bond that they've taken a good collateral from them, and these collaterals can be in the form of personal guarantees of the promoters. It can be in the form of shares or securities of those companies. In some cases, they are also in the form of properties, mortgage properties, which are backed, like PTCs, as I showed you. PTCs are backed by mortgages. So a default risk is very simple. You invest in something, and there is chances of that particular instrument to default on the payments. But according to us, the research that we have done, the companies that we select, our selected mutual funds have a 2 to 2.5x kind of a collateral backed funding in those funds. Collateral backed funding in those funds.
Can you tell us what happened to the Franklin debt mutual fund which collapsed suddenly?
Yes, so Franklin in March decided to shut down 6 of their debt mutual funds. In March, what was happening was, because of COVID, they were getting a lot of redemption pressures, because obviously in a lockdown kind of a period, people wanted to withdraw their money. Plus, that particular mutual fund, that particular the 6 schemes which we talked about, some of the schemes were not performing for a while also, so people were redeeming their money. So Franklin on April 24th, they decided to shut down their 6 mutual funds. And that's a clause in SEBI which says that you can actually wind up your mutual funds whenever you want. So any company can decide that they're closing up the mutual fund or a particular scheme, and they return back the money. Now Franklin said that we'll be closing this mutual fund because because they were getting a lot of redemption pressures. So what does that do? Let us understand this in a little more detail, as Mr. Miglani has pointed out, to discuss this. Let's say I have 100 rupees today, and I am a mutual fund owner. I am running a particular debt scheme. 100 rupees I've invested, let's say, across 50 bonds. And there are a lot of investors who invested this 100 rupees. Now, if people, start redeeming this money at a very bulk kind of a scenario, what will happen is I'll have to sell my papers because I have to honor that redemption. So let's assume that paper was available with me at 10 rupees. I bought a particular debt paper at 10 rupees, but because I have to redeem, and because I have to according to SEBI, give that redemption back to people who are asking for it, I might have to sell a very good paper of 10 rupees, which I know I'm getting a very good return on. The company is also stable, but because of the situation, I might have to sell it at a discount. I might have to sell it at 9 rupees, right? And take that discount. Now, what does that do? People who are exiting will get their money, but people who are patient or are staying with the fund, tend to lose out because of others. So Franklin decided, that this will create a problem for us, because people redeeming, and we have to give up our good papers also at a discount. And at that time, because it was COVID, there was a complete lockdown at that time. The papers they had to sell were selling at a 15% discount or a 10% discount. So, that Franklin said that let's do one thing, let's close down these funds and let us give the money back to the investors, so that we can justify the investors the amount of money that they have invested with us, and also justify the returns to the investors. So they decided to close down the fund, and the winding up procedures were undertaken. Where they had to take a consent. The trustees gave the consent, but the winding up procedures also needed a consent of the unit holders of who will wind up. But simultaneously, there was a group of investors who had put in a a court case in Gujarat first and then in Karnataka first, where the investors had this thing that, because they had invested in a open-ended fund, why should their money be, not given back to them in whenever they want, right? Why should the decision be lying with Franklin to give back the money? So they put in a court case for which, we've got a verdict from Karnataka court case, from Karnataka court, High Court, where Karnataka High Court has given Franklin a direction that before winding up, you take the consensus of all unit holders, whether they want to wind up or whether they want to not wind up and take out their money from the fund. So that's the current status of that Franklin fund. But if I talk about the securities over there, the securities over there are still backed up. So there, even if you get the money by winning the case, or if you get the money by Franklin winning the case, either ways, the bond papers which are there with Franklin are backed up by securities, and these securities are of different nature. Some are backed up with stocks, some are backed up with personal guarantees, but they are backed up. And some of the papers also have a 2x kind of a backing up.
But if I need a money today, I will not get it, right?
If you need your money today in Franklin, you will not get the money today in Franklin.
Yeah, say if I am retired and I had put the money in Franklin, I will not get the money till the time whatever proceedings happens, and then I'll get it.
Correct.
Okay, another question is the fund which you showed us showing 12% plus returns in a debt fund. I see riskometer reads moderate risk. Can you just tell me what does that mean?
So riskometer is there according to SEBI. You have to put a riskometer because, as you I think pointed out, that there are both interest rate risks and credit risks in debt mutual funds. So that particular fund has about 60% of government securities. So because it has government securities, it has an interest rate risk in that particular fund, because if tomorrow the interest rates goes up, those 60% government securities will be available at a discounted price. So because it has interest rates risk, that's why it's under a moderate category.
For that matter, all debt funds will have the interest rate risk? No?
No. So for example, risk might be different for different mutual funds. So for example, a government security. Now, if I'm buying a government security today for 10 years, my interest rate risk in 10 years becomes very high. But let's say if I buy a debenture or a bond for 2 months or 3 months or for 6 months, my interest rate risk goes down.
And so does the returns as well.
Of course.
How do you suggest investment in gold funds or directly ETF, gold ETFs?
Mr. Singh, it's not a bad option, but we as advisors, we do not recommend more than 5% or 10% allocation into gold, because so according to our mindset, we feel that gold is something which performs in cycles which are very long. So for example, it reached 30,000, I think if I recall correctly, around 2012 or 13 I think, if I'm not wrong, which gave a very good rally at that time. But after that, I think for the next 6 years, it did not perform. And in 2019, I think October 2019 is when it started going up again. So it's a matter of patience. And we feel that 6-7 years, 8 years for something to perform, and that too if you're not sure, and that too the rally doesn't go on for too long, right? So it goes up in, let's say, 6 months, 7 months, and then it stops, and then it waits, for. So for us as advisors, we feel, for us as a company, we don't advise more than 10% into gold, but it's good to have as an asset allocation, of course. So we are open to take any other questions as well. If you have any doubts, anything that you would like to ask, we'd be happy to take that.
In addition to these mutual funds, can you suggest something else also? Because if we can split our investment into 3 areas.
RNG, absolutely. See, we have, that is very specific, but, when we sit down to do retirement planning, we'll probably suggest you a senior citizen plan also, which you can invest into. We'll probably suggest you a debt mutual fund. We probably will suggest you an equity mutual fund. We might suggest you a gold ETF. So it completely depends on individual discussions. But as of now, these are the good plans available for retirement, or, because apart from this, if you go for an FD rates are too low right now, and plus they are taxable also. Just a second, sir.
Can you suggest some insurance linked schemes where you can get the good return without paying income tax? Are you?
So we don't recommend the insurance link, because as I said, insurance linked schemes are, the guaranteed ones. One are which are ULIPs, which are unit linked plans. They are pretty similar to mutual funds, right? You have equity exposure there also, equity risk there also. But if I talk about guaranteed plans, you put it down on an Excel. So I'll suggest anybody who or any plan that you come across with which you think is lucrative, you put it down on an Excel and take out the IRR of that particular plan. We have reviewed almost all the companies which are there in the market right now. We've not got anything which is more than 6% ever.
Yeah, you're right.
Right. So that
we can put some money, because in any case nowadays, if it is guaranteed 6% without tax, I think that should be good enough.
सर आपका पैसा भी तो ब्लॉक हो रहा है ना, लिक्विडिटी भी तो नहीं रह रही ना उसमें.
No, liquidity तो ठीक है, but we are talking about our continuous returns.
Continuous returns, yes sir.
Not there.
एनुइटी तो आप उसमें ले सकते हो. मैंने जैसे बोला आपको, आप सेकंड ईयर ऑनवर्ड्स एनुइटी ले सकते हो, बट आपको प्रीमियम भी तो देना पड़ेगा ना उसका. आप 10 साल आप 10 साल का जो भी आप अमाउंट में आप प्रीमियम रखोगे, एंड देन यू हैव टू कीप दैट मनी देयर ओनली. व्हाट इफ आफ्टर रिटायरमेंट यू नीड योर मनी आफ्टर 5 years due to any emergencies? You don't know that, na?
That's what I'm telling. Not 100%, maybe 10%, 20%.
So we don't recommend that. We feel that अगर आपके पास options available है जहाँ पे आपका पैसा liquid है और आप एक दिन के अंदर अपना पैसा निकाल सकते हो without facing any interest penalties, without facing any penalties of that matter, we feel that is better rather than blocking your money for the, let's say, next 15-20 years. And return भी बहुत lucrative नहीं है, to be very honest. मतलब अगर आपको lock नहीं करना है तो आप PPF में डाल सकते हो उसको.
For the younger generation, what do you suggest about NPS?
Sir, NPS is a good option. Of course, you get a additional 50,000 rupees of tax saving apart from ATC. So मतलब अगर if you're in a 30% tax bracket, तो अगर आप वो 50,000 का देखो तो आप सीधा 30% तो बचा ही रहे हो. जो भी उसमें रिटर्न आएगा ऊपर वो अलग आएगा, मतलब बट वो तो बचा ही रहे हो. So NPS I think you should do. 50,000 rupees is not that much, and it saves tax for you. But if you are not after retirement, if you're not falling into the highest bracket, or if you are saving tax with ATC, then you can avoid NPS. Otherwise, I think NPS is a good option to have.
So we have one more question by Mr. Rajeshwari, who's typed in the chat box. What are the typical charges for advisory? So, sir, I'd like to inform there are two types of services available in the market. One is with respect to research advisory, and one is with respect to mutual fund distributor. So, charge their own fee, they will have their own fee model, but then they will have you invested into direct mutual funds where you will not be paying any other fee. We are mutual fund distributors. We, as per SEBI regulations, cannot charge our investors for any sort of an advice. There is a total expense ratio, which becomes a part of our remuneration wherein you invest. So the total expense ratio in itself varies between 1 to 2% depending upon the types of mutual fund that you have, which becomes our fee. There are no other advisory charges that we will be charging. Abhishek, there was one question on the types of debt mutual fund that is specifically that can be taken.
So in type of debt mutual funds, we have different types, and these types are dependent on the time horizon of funds, and the returns are also directly linked. So for example, we have a liquid fund or an overnight fund, which is there for parking your money for, let's say, 10-15 days. You want to park your money for 10-15 days and get out of it. You can do that in a liquid and a money market fund. The returns are obviously lower. Then you have ultra short-term funds, which you can park your money for, let's say, up to 6 months. We have short-term funds for up to 1 year. We have medium duration funds for 2 to 3 years. And then we have long duration or government security funds, which are ideally more than 5 years. So in all of these, the returns with the duration, the increases. To simplify things, treat it as you go to a bank, you get different options of FDs. You get a 30-day FD, you get a 3-month FD, you get a 6-month FD, you get a 1 year, 2 year, 5 year. So treat it as that. Similarly, in debt mutual funds, we have short duration, ultra short, liquid, we have medium, we have long duration.
So broadly speaking, what you are suggesting is that we can go for maybe up to 10% in gold ETF, maybe around 60% of our allocation as we we are nearing retirement should go in that debt mutual fund, and that 30% you can think of into equity mutual fund or maybe somewhere else. That would be a good distribution.
Yes, sir, it will be, but I'm again repeating that, it's very subjective and very subjective to the individual, because, if you don't have the equity appetite, let's say if I tell you that in the next 7 years you should get a 12% return, but you might also get a minus 20% return in the next 2 years. So, you might be comfortable with it, but somebody else might not be comfortable with it. So it completely depends on the individual. But if I have to give you a very general or a ballpark figure, that thing looks good, what you just said.
Yeah, okay, thank you.
Abhishek, how to get in touch with you for any further advice?
I think, Shalini, I think you've given your contact details to the HR.
Yes, my coordinates are already available with Ms. Triti Sharma. Otherwise, I will be sharing a slide over here. You can take down our coordinates from here. We will be available at these coordinates. So these are my coordinates. You can take these details down, and please feel free to get in touch should you require a one-on-one session.
Not legible. Can you increase the size or make it?
It's not possible to read.
Can you read it out, Shalini? Can you read out your number, please?
I will type it in the chat box if that's okay, because
that's better.
Okay, just one question which I forgot to take, and I've got another question in the chat box. that if the fund managers are taking care of the funds, why do we need to reallocate? Now, this question was also raised before in the presentation. I'll just give you a very small example. I think all of us have been following, we read Economic Times and all the newspapers regularly. How many of us remember the Reliance Vision Fund or the Reliance Growth Fund? बहुत popular हुआ था किसी time पे. I think 2009-8 की बात है. Then Aditya Birla Frontline Equity का बहुत चर्चा आया था पेपर में, that Aditya Birla Frontline Equity एक फंड है, बहुत अच्छा फंड है. Then DSP Tiger Fund का आया था. So what happens is that first of all, every fund has a period of giving returns, and we have to monitor it regularly, because see what happens is in mutual funds hote kya hai, right? At the end of it, they take stocks aage, right? Equity mutual funds I'm talking about, of course, and debt mutual funds में आगे bonds लेते हैं. So we as advisors, we need to see कि वो कौन से stock ले रहे हैं और whether वो stock सही है कि नहीं है. कई cases में we have seen that where as advisors we are not comfortable with the stocks that somebody has taken. We talk to the fund manager, he gives his logical rationale कि मैंने इसलिए लिया उसलिए लिया. We some cases we agree with it, some cases we don't agree with it. Then secondly, there are times. So for example, 2014 से लेके 2017 तक, या I'll say 15 से लेके 17 तक, small cap funds ने बहुत ही अच्छा return दिया है, right? People who were invested in small caps in 2014, 15, they have got more than 50-60% return per annum till about 2017. But 2017 से 2020 में क्या उतना return आया small caps में? I feel large caps में better return आया उस time पे rather than small cap funds. And there was a brief period in time जहाँ पे I think 2018 if I'm not wrong, where the equity markets were not performing at all. उस time पे debt markets अच्छा perform कर रही थी. 2019 के आसपास में, not talking about the credit risk funds, but I'm talking about funds like, as I showed you, the medium duration funds. They were giving good returns at that time. So we need to look at portfolios at a regular interval. There was a strategy a while back कि आप एक fund में डाल दो and भूल जाओ. ऐसा नहीं होता. We have to see, because see fund में भी क्या हो रहा है, fund में भी fund managers change हो रहे हैं. जो आपका पैसा आगे allocate कर रहा है, जो decisions ले रहा है कि क्या stocks लेने हैं मुझे, वो भी change हो रहा है 3 साल बाद, 4 साल बाद, 5 साल बाद. हो सकता है कोई नया fund manager आए, उसका point of view different है. अभी fund का नाम वही है, but backdrop में जो manage कर रहा है उसको वो change हो रहा है. So you actually need to do active management of your fund. Abhi, for example, I wanted to avoid names, but for example, abhi HDFC top 200, Aditya Birla Frontline Equity कहीं पे भी नहीं है top returns में. We have funds like Canara Robeco Blue Chip. We have funds like Mirai Large Cap, Axis, which have come into picture, which are large cap category of funds only. So we need to review funds. We need to make active decisions on funds also. कई केसेस में हमें ये भी करना पड़ेगा कि हमें एसेट एलोकेट करना पड़ेगा. लाइक जब मार्च में जब मार्केट्स नीचे गई थी अबाउट 40%, उस टाइम अगर आप रिटायर्ड भी थे फॉर एग्जांपल, या फिर आपका रिस्क एपेटाइट कम भी था, आपका 80% अगर डेट में पड़ा हुआ था और 20% इक्विटी में पड़ा हुआ था, वी विल कम टू यू एंड सजेस्ट यू कि आप अभी 10% ही इक्विटी में चाहे शिफ्ट कर दो, बिकॉज ये अच्छा टाइम है अभी शिफ्ट करने का. 25,000 का सेंसेक्स, 26,000 का सेंसेक्स मिलना बहुत, मतलब उस टाइम पैनिक जरूर होता है, बिकॉज आपका जो इन्वेस्टमेंट है वो नीचे हुआ है, बट वैसी अपॉर्चुनिटी भी नहीं मिलती अगर उसको दूसरे लेंस से देखा जाए, तो उस टाइम पे डालना ज्यादा सजेस्टेड था. So you have to do these changes regularly.
But don't you think people get wiser after seeing the returns than to take the decision upfront and then deciding what is the right course?
Sorry, sir, I did not get your question. Can you repeat that, sir?
I said everybody gets wiser once they see the returns. I know if I see the returns for last 10 years, it's very easy. किसी ने इसमें डाला होता तो ये हो गया होता वो हो गया होता. But deciding today and predicting future will definitely not a different code.
Sir, see क्या होता है कि हाँ, I take your point. I get what you're trying to say. अभी फॉर एग्जाम्पल जैसे हम अगर मार्च की बात करें, मार्च में उस टाइम पे जाते हैं वापस, अगर मार्च में वापस जाते हैं, पैनिक था, लॉकडाउन हो रहे थे, वर्ल्ड में लॉकडाउन हो रहे थे, इंडिया में लॉकडाउन होने वाला था. इनफैक्ट एक लॉकडाउन मतलब एक जनता कर्फ्यू हो गया था 22 को, 24 को मार्केट 26,000 पे गई थी. सो उस टाइम काफी पैनिक था. बट एज एडवाइजर्स देखो, हमें एक रैशनल डिसीजन आपको देनी होती है. सो when we look at data, we don't look at data as far as we have a lot of technicals to look at. Like for example, उस वक्त market cap to GDP 48-49 के आसपास हो गया था, which was the lowest ever. आज तक हुआ ही नहीं कभी 48-49, right? So we knew कि investing at that point was a good idea. Now we did not know at that time कि मार्च में अगर हम इन्वेस्ट करेंगे तो हमारा नवंबर तक मार्केट वापस 41-40 पे चले जाएगा. We did not anticipate that, to be honest. But we knew कि मार्च में इन्वेस्ट करना अच्छा टाइम है इन्वेस्ट करने के लिए अभी, और हम वो कॉल दे सकते हैं कॉन्फिडेंटली. सी, जब हम लमसम का कॉल कॉन्फिडेंटली दे सकते हैं तब हम लमसम का कॉल कॉन्फिडेंटली देते हैं. जब हम नहीं दे सकते, वी डोंट रेकमेंड दैट. सो यू आर राइट कि अभी पास्ट डेटा देख के लगता है कि करना चाहिए. But even at that time, when you are taking that decision, there are a lot of pointers which you can look at and take that decision very easily. I hope I was able to answer that.
Yes.
We can take any other questions. If you would like to ask us anything, we're more than happy to answer the questions. We've also shared our details on the chat window, so anytime you would like to have a discussion with us, we're more than happy to have these discussions as well. So any questions for us, we'll just wait for another minute for any question to come in. Otherwise,
Again, tell us the typical charges. I missed that point that time.
Charges for an advisory?
Right.
Okay. Shalini, would like to take that again?
Yeah, sure, sir. So, sir, I mentioned that there are two types of models which are there in the market. One is the research advisory model, one is a mutual fund distribution model. This is as per SEBI guidelines. So, a research advisor will charge his own fee structure from you, but at the same time, he will ask you to invest in a direct fund where there will be no other further additional charges. We are a mutual fund distributor. We do not charge any advisory fee from the investor. As per SEBI guidelines, we are not allowed from the investor for an advisory. Our remuneration or our payment comes from the investments that you do. So your investments will be undertaken in a regular growth mode and have a typical expense ratio, just to the tune of 1 to 2%, depending on the mutual funds that you invest in. From that total expense ratio, our fee income will come. There will be further charges that you will be charged.
Okay, thank you.
Sure.
Yeah, many of these banks, when they see there is a large, any client having maybe around 20 million or so in his account, they appoint you a relationship manager. how would you recommend to heed to their advices and maybe if they are suggesting something?
So,
Of
sir,
course, there is a hidden agenda because they will try to maximize. Apart from giving you some advices, they will try to maximize their own returns in terms of percentage of whatever the investment you are making. But how good that advices can be.
so we will be undertaking an individual discussion with the investor. We will be understanding his financial goals, his risk appetite. There will be a complete.
No. So you didn't get my question. I am talking about that like HDFC Bank, ICICI Bank, and all those. They assign a relationship manager to you, and who in turn interacts with you regularly. So how good or how bad to go with their suggestions?
All right.
And what is your feedback on that?
Sir, we would not desell anybody. We would never tell you that an HDFC bank or an ICICI bank, any bank is bad in terms of their advisory. But I would always suggest that whenever there is a financial discussion, please make sure that you are talking in terms of your financial goals, you're talking on your risk appetite, you're understanding the investment tenure, you're understanding the amount of risk that you are taking, and you have an expectation of the returns that will be generated from your portfolio. At the same time, I would strictly advise you not to go for any investment cum insurances plan where there is a guaranteed outflow which is coming into the picture, because as I mentioned in the beginning, these guaranteed flows will have a low return component attached to them. So as long as you're going for pure investment products like mutual funds, like stocks, like PMSs, as per your risk appetite, you are good to go.
So what I hear is that at this age, you don't suggest any of this insurance-linked plans.
No, sir, definitely not. They have a lot of hidden charges associated with them that are not revealed to the investor at the time of the discussion. It is only when the final booklet comes to you, you realize that there are so many charges which are being deducted from your premium itself prior to getting into the plan.
Yeah, okay.
So any other questions that we have, or we have crossed our allocated time? So can we close the discussion, or are there any other final questions left? All right, I think Abhishek has suitably answered all of the questions. We have already left our coordinates in the chat box, and it was also displayed on the screen. My team members would be getting in touch with some of you who have shown interest in being contacted. We've already received your coordinates, your contact details. My team will be getting in touch over the next 1 or 2 weeks to understand your individual needs. And if anybody wishes to go for an individual advisory session, please let us know. We are conducting all of these financial sessions over video conferences. With that, I will be ending this session. Thank you so much, Tripti, for being a wonderful organizer once again. Thank you, all employees at Engineers India Limited, for being a wonderful audience and an engaging audience. I would like to end this session now. Please stay safe and stay healthy. Thank you.
Thank you, Shalini.
Yeah,
thank you, Abhishek, for the input. Thank you, participants, for joining in.
Thank you.
Yeah, thank you, everybody.
डेफिनेटली रिस्क भी नहीं और भी होता है